This is Larry Russell. Today I'm going to talk to you about automated tax projections in the VeriPlan lifetime financial planning software application. In summary, VeriPlan automates lifetime tax projections in a very sophisticated way. The first bullet here is just a commentary on a lot of other software packages that use average tax assumptions. They're just going to produce a biased projection for you, and frankly, this just represents to me poor design and lazy programming. And the real reason for this is everybody's tax situation is unique, and it's going to evolve over time. So if you want to actually have a projection, you need some high quality software that's going to reflect your particular tax situation over your lifetime. So behind the scenes, VeriPlan fully automates and it will customize your tax projections. And by doing this, you don't have to sit there and try to do all these back of the envelope calculations. You can actually focus on making better financial projections. We're going to move very quickly now to taking a look at actually how VeriPlan works. I'd like at this point to summarize the assumptions I've already put in there. I'll go in and show you where these are done, but we'll be talking about a 30-year-old married couple that live in New York. New York State, that is. New York City would have additional taxes, and that would also be reflected if you wanted to. They have a gross annual income of $120,000. Their residence is worth $500,000. They've got a mortgage of $400,000. Still have remaining student loans of $20,000. Their annual living expenses are $60,000, which is about half of their gross income. Now, just to understand, the living expenses don't include paying off the mortgage, and they don't include taxation, and we'll get to that in a little bit. They have a portfolio at this point of about $50,000, and their asset allocation model is to hold 10% cash, 30% bonds, 60% stocks. They intend to retire at age 67, and along the way they intend to fully fund their IRAs and a 401k that one of the earners has. And when they get to retirement, they expect to have 2 Social Security checks. Now, I'm going to look at this slide here. If you want to, you can pause and look at the details here, but I'm not going to go into them because when we flip over to VeriPlan, you'll actually see how these are implemented specifically like this. Okay, so here we are taking a look at the income input page. Up here is entering a 2 is for married taxpayers. 30 years old is the initial age for the first earner. The second earner is also 30 years old, and we also just put in 67 as the retirement age. If you scroll down a little bit on this page, you'll see that for earner number 1, he or she will have annual wage and salary income of $80,000, and the partner will have $40,000 in gross earnings, so the total for the family is $120,000. In terms of expenses, this is the annual expenses of $60,000, and again, it doesn't include any taxes, any debt payments, any of your savings or major expenditures, which in this case we have not modeled. Now, there are 2 ways to enter your financial assets. My preference is always the very detailed method because you can do a lot more with it. But if you enter a 2 here, you just simply can enter aggregate amounts in your various types of accounts by taxability. So there's $25,000 in taxable accounts. They have $25,000 in traditional tax advantage retirement accounts such as IRAs and 401ks. Now, here is the data entry page for all kinds of real estate, including rental real estate, which is sections below, as well as debts. In this section here, one can enter information about various homes that are owned. This column here is for their primary residence. This is the $500,000 value. The assumption is that in real dollar terms, after inflation is taken out, the home will appreciate about 1%. The tax basis is $450, and that's just noting this here that underlying VeriPlan is a tax basis model that takes into account for all the assets and the value that you've already paid tax on. So you're not paying double tax on that. And here's the debt that's owed, the mortgage debt, $400,000. We're assuming 5% interest, and this is the monthly payment on a 30-year fixed. Down here is the annual real estate taxes of $6,000, and this is the assumption for annual maintenance expenses of about $3,000 a year. Scroll down a little bit more, and we find the debt section. This labeled student debt here. This is the $20,000 in student debt. Interest rate of 5%, and so with a monthly payment of $377, which would pay it off in about 5 years. In terms of taxes, the only tax input one needs to make is to just use this pull-down menu to select a particular state of residence from among the 50 states plus Washington, D.C. Now let's just reset this thing back to the New York State, and there we are. So now, if we, there's a large, and we'll come back to this in a second, but there are large, long listing of various types of taxation adjustments and modifications that you can make here, and we'll come back to this in a second. Regarding retirement inputs, here we're putting in the Social Security expected payments by age 62 and full retirement age and age 70 for both earner number 1 and earner number 2. And then down here we're selecting the age at which they expect to begin taking their checks. Here is where we can select whether or not they have an employer retirement plan that they can contribute to. In this case, only earner number 1 has one, and that's selected by using this pull-down menu. In this case, they work for a profit-making company and have a 401k. So in terms of asset allocation, there are a variety of methods that you can use here. I'm just simply using method number 3, where you can use a constant percentage allocation over time and pick whatever percentages you want. In this case, I picked 10% cash, 30% bonds, and 60% stocks across a lifetime. So now let's go over and take a look at the big picture. And this is in the graphics here. This is the total asset projection. So the total assets indicate that over their lifetime, starting at age 30, and this is the age time scale, all are on an age time scale, going up to age 100. This couple is projected to have about $3 million if they both were to live to age 100, and that would mean that along the way they've fully paid all their expenses and paid off their debts, etc. The reason why this drops below 0 at this point, this reflects the debt that's pulling their total assets down over time. So now let's go and take a look at the personal taxes output. This is the graphic that shows how much taxes over time they're going to pay, and this is their working lifetime here, and this is given the fact that they stop working at 67 and some of their earnings, such as one of the Social Security checks doesn't start until age 70 plus. This is the point at which this is for required minimum distributions that must be paid out and taxed from retirement plans. So these are the various tax categories that VeriPlan is automatically calculating. This is the federal taxes. This is state and local taxes. This here is Social Security taxes being taken out, FICA. This is the other component of FICA, which is the Medicare taxes. And by the way, just so you know, FICA, if you have self-employment income, it handles both the employer and the employee side of Medicare and Social Security taxation. This area here represents the residential mortgage and real estate taxes, and then up here what you see is this is the same. This is federal. This is state taxes. This is again the the real estate taxes, obviously they're no longer working, so there aren't any taxes taken out for Social Security and Medicare. And this, as I said before, is the required minimum distribution, which is taxes taken out from related to retirement plans. So now let's go back to the tax input table. Again, to point out, the only required input one needs to make is to select from the pull-down menu. But all of these categories of taxes and tax adjustments are available if one actually were to need it. And it also just allows a person to understand what's going on. Here are the federal income tax rates right now that are being used. If you scroll down a little bit more, you'll see that there's no obsolescence built into VeriPlan. If you wanted to change the taxes over time or just play around with different tax rates, you can make the change here, and then all you do is simply substitute a 2 for a 1 here, and that would begin to use these tax rates here. If you go down a little bit further, this is the state tax rates that are supplied. So this is, as we see this right here, this is for New York State here, married here, single taxpayers there, and again the same method that you can use to change the taxes on a state level and then switch between a 1 and a 2. The next area is, and some of you may not believe this, but there are many areas of the United States where you have to pay local income taxes as well. And so this is where you can choose the local income taxes rates. You can fill them in right here, and then down here you can select them. I've actually used a particular model for New York City. This particular couple doesn't live in New York City, but if they were to live in New York City, we simply could put in a 3 here, hit a carriage return, and what happens there is now the plan is using these tax rates here. So let's just reset this back to a 0. The next section is, in certain states, if you pay attention to your taxes, you'll notice that that when you compare the federal taxable income to state taxable income, there's a big difference in terms of what's taxable. And if that were the situation, you wanted to make an adjustment in this section here, you could actually make the adjustment, and which would set VeriPlan up to assess taxes on a proportional basis, depending on how much taxable income you actually had. The next section is, this is if you have additional personal exemptions and dependent deductions. You can enter them all here, and then it'll automatically be projected throughout time. Down here is that there are some on your 1040 tax returns where if you expect to have regular tax adjustments, you can actually enter them here. Next section is, this is long-term federal itemized tax deductions. If you have certain long-term federal itemized tax deductions, you can enter them here. The thing, by the way, to note about VeriPlan is it will automatically assess the better for you of either the standard deduction, or, for example, if you have a home mortgage and higher real estate tax deductions plus mortgage interest deductions, it will automatically assess the itemized deductions there, and also take this information into account if you add it in here. And moving on, this section is just information only, as we saw back here in property and debt. This is where you enter information about real estate taxes. So this just simply summarizes that. And I believe I mentioned before that you can have rental properties in other sections here. This is these sections down here where you can automatically enter rental properties here, and you can have other businesses as well. So, but that's for a more sophisticated model than we're doing right now. So the next section down here is just, you wouldn't probably never have to change this because the rates are expected to stay the same. But this is Social Security, medical, and Medicare payroll tax rates, This is, let me see here, and this is phase outs and things like that. Oh, this is long-term capital gains tax rates. Automatically, VeriPlan is calculating long-term capital gains if you dispose of assets, and will implement that. Also the net investment income tax section you can read here to understand better, but that's all automated as well. Just so you know that, and here's an example I can do. There's an exclusion on a primary residence if you sell it. And without going into the details behind that, it can be substantial. A single taxpayer may be able to use a $250,000 exclusion, and a married taxpayer may be able to use a $500,000 exclusion. So I can just quickly illustrate that. Built into the real estate logic is the ability to just plan the sale of a property sometime in the future. So let's just imagine that this couple 40 years from now decided they were going to sell their property when it's already there. They had 2% in sales costs. So if we look out at the project, and by the way, just to be clear on this, to model this would be more sophisticated than this, because they're going to sell their house in 40 years. They're still going to need to live, so that you'd have to put in additional expenses on a yearly basis related to the rent that they would need to pay thereafter. But just to see what happens here is, let's just look at total assets. All of a sudden, you see that about 40 years out, boom, this is gone, the real estate is gone, and then their remaining assets jump up. If you go and again, before we saw the total of $3 million, now the total is over $5 million, but that also doesn't reflect the fact that throughout this period of time they'd have to pay taxes. But let's go back and actually look at personal taxes. Where they're selling is at this point in time. If they actually had to pay taxes on the full capital gain and couldn't have automatically excluded the $500,000 exclusion related to selling their primary residence, then this number here would be substantially larger at this point. So to sum up, the VeriPlan financial planning application has very sophisticated internal tax projection logic. You don't have to rely on just some general average assumption. You can be assured that whatever is happening for your particular family's financial affairs, the underlying taxation picture being projected is sophisticated and will get you closer to an understanding of what might happen related to taxes in the future. Thank you for listening.